Silver just broke through $85 per ounce. And if you're watching this video on February 12th, 2026, you're witnessing a historic recovery that's defying all the bearish predictions that came after the worst crash in silver's history. As of 8:30 this morning Eastern Time, silver was trading at $85.65, up $3.77 from yesterday at the same hour. That's not just another daily move, that's silver breaking through a major psychological and technical resistance level that many analysts said would be impossible to reach this quickly. 2 weeks ago, silver was at $75 after crashing 41% from its all-time high of $121. Now we're at $85.65, representing a recovery of over 14% from those lows, and the momentum shows no signs of slowing down. I'm going to break down exactly what's driving this historic recovery, what breaking through $85 means for where silver goes next, and whether this is sustainable or if we're setting up for another violent reversal. Let me start by giving you the full context of just how remarkable this recovery has been, because numbers without context don't tell you the complete story. On January 29th, 2026, silver hit an all-time record high of $121 per ounce. It had been on an absolutely incredible run, rising from around $31 a year earlier. That's a gain of nearly 300%. But then came the crash. In a single trading session, silver fell 35%, the largest single-day percentage decline in the entire history of silver trading. Over 3 days, silver crashed from $121 down to $75, a loss of 41% from peak to trough. At that moment, with silver sitting at $75 and billions of dollars in leveraged positions wiped out, the consensus view was overwhelmingly bearish. Analysts were coming out with predictions that silver would fall to $60, $50, maybe even back to $40. The narrative was that the entire rally from 30 to 121 had been nothing but a speculative bubble built on excessive leverage, and now that the leverage was being flushed out, we were going to see a complete collapse back to fundamental value. Social media and financial forums were full of people posting their losses, swearing they'd never touch silver again, warning others to stay away. But something remarkable happened over the past 2 weeks. Instead of continuing to collapse, silver found support. It stabilized in the $75 to $78 range for a few days, and then it started climbing. First to 80, then to 82, then to 83, and now we've broken through 85. This isn't just a technical bounce or a short squeeze. This is a sustained recovery driven by real fundamental catalysts, and the fact that we're now above $85 just 2 weeks after touching 75 tells you that something important has changed in how the market views silver. So what's driving this recovery? What changed between 2 weeks ago when everyone was predicting doom and today when we're breaking through major resistance levels? Let me walk you through the specific catalysts that have emerged over the past 2 weeks that are powering this move. The first and most important catalyst is the complete shift in Federal Reserve policy expectations. When silver crashed in late January, part of the trigger was the nomination of Kevin Warsh as the new Fed chairman. Warsh is known as extremely hawkish, favoring high interest rates to fight inflation. That nomination caused the market to price out rate cuts and strengthen the dollar, which was bearish for precious metals. But over the past 2 weeks, economic data has been coming in consistently weak. Retail sales unexpectedly stalled in December. The GDP control group fell 0.1%, a negative number indicating economic contraction in that key measure. Consumer spending, which represents 70% of the US economy, is showing clear signs of weakness. When you get this kind of data, it doesn't matter how hawkish the Fed chairman is, the Fed has to respond to economic reality. You can't maintain restrictive monetary policy when the economy is showing signs of contraction without risking a severe recession. As a result, the market is now pricing in roughly 60 basis points of Federal Reserve rate cuts by the end of 2026. That's a complete reversal from the expectations just 2 weeks ago. 60 basis points represents about 2 to 3 rate cuts over the course of the year. Lower interest rates are extremely bullish for precious metals like silver because they reduce the opportunity cost of holding non-yielding assets, and they typically weaken the dollar, which makes silver cheaper for international buyers. This shift in rate expectations is one of the primary drivers of silver's recovery from 75 to 85. The second major catalyst driving this recovery is what analysts are calling a rotation away from dollar-denominated assets. This is a bigger story than just silver. This is about a fundamental reassessment of risk in the global financial system. There are growing concerns about policy uncertainty in Washington, massive and growing government debt levels that now exceed $35 trillion, geopolitical tensions around the world, and questions about the sustainability of the current fiscal and monetary trajectory. When investors start to worry about these issues, they begin looking for alternatives to traditional dollar-based investments like stocks and bonds. Precious metals have historically been the primary alternative during these periods of uncertainty. We're seeing real money flows out of dollar assets and into gold and silver as safe haven hedges. This isn't just retail investors buying a few coins. This is institutional money starting to allocate capital to precious metals as portfolio insurance against currency debasement and financial system instability. The fact that both gold and silver are rallying together confirms that this is a macro-driven move based on safe haven demand rather than something specific to silver's industrial applications. The third catalyst, and this one is really important for understanding the sustainability of this move, is the physical market dynamics. While silver futures crashed in late January due to forced liquidation from margin calls, the physical market remained tight throughout the crash and has actually gotten tighter since then. Physical premiums, which are the amount buyers pay above the spot price to get actual silver bars and coins delivered, have remained elevated. Mints are reporting shortages. Inventories at major exchanges in London, New York, and Shanghai are extremely tight. In fact, silver inventories at the Shanghai Futures Exchange recently hit their lowest level since 2015. This tightness in the physical market is showing up in other indicators as well. Lease rates, which are the cost to borrow silver for short periods, have been rising. When lease rates go up, it indicates that there's genuine difficulty in obtaining physical metal, not just speculative positioning in paper futures. This combination of tight inventories and rising lease rates tells you that the crash to $75 was entirely a paper market phenomenon driven by leveraged liquidation. The fundamental supply-demand balance for physical silver never deteriorated. In fact, it's gotten tighter. There's also fresh data that confirms the structural bull case for silver over the medium to long term. The silver market is expected to remain in deficit for a sixth consecutive year in 2026. A deficit means that total demand exceeds total supply. 6 years in a row of deficits is not a temporary imbalance, it's a structural shift in the market. When demand exceeds supply year after year, inventories get drawn down and prices have to rise to either stimulate more supply or destroy some demand. That's basic economics, and it's playing out in real time right now. On the demand side, there are two major components to watch. Industrial demand, which accounts for more than 50% of total silver consumption, is forecast at around 650 million ounces for 2026. This is actually down about 2% from previous years, and that decline is happening because manufacturers are working hard to reduce their silver usage at these elevated prices. They're redesigning products to use less silver per unit, improving efficiency, and looking for substitutes where possible. However, and this is crucial, they can't eliminate silver entirely in many applications because of its unique properties, particularly its superior electrical conductivity. The more exciting part of the demand picture is investment demand. Physical investment in silver is forecast to rise by 20% in 2026 to a 3-year high of 227 million ounces. That's a massive increase in investment demand, and it reflects Western investors waking up to the silver story and allocating more capital to precious metals. Global exchange-traded product holdings currently stand at an estimated 1.31 billion ounces. When you see investment demand surging by 20% while the market is in a structural supply deficit, that creates powerful upward pressure on prices. Let me give you some perspective on just how dramatic silver's performance has been over the past year, because this context is important for understanding today's breakout above $85. Even after the crash from 121 to 75, and now the recovery to 85, silver is still up 162% compared to 1 year ago. If you had bought silver in February 2025 at $31 per ounce and held it through everything, through the rally to 121, through the crash to 75, through the recovery to 85, you would have made over 160% on your investment. That's an extraordinary return that beats almost every other major asset class over the same period. This year-over-year performance tells you that real fundamental forces have been driving silver higher, not just speculation. You don't get sustained gains of over 160% over 12 months without genuine underlying drivers. The supply deficit story is real. The growing industrial demand from solar panels, electric vehicles, and increasingly artificial intelligence infrastructure is real. The rising investment demand is real. These aren't temporary factors that disappear overnight. They're structural drivers that should continue to support higher prices. Now let's talk about what breaking through $85 means technically and psychologically, because round numbers and resistance levels matter in markets. $85 has been a key level that traders and analysts have been watching closely since the recovery from 75 began. It represents roughly the midpoint of the decline from 121 to 75. When you recover half of a major decline, it's often a signal that the worst is over and a new uptrend is establishing itself. Breaking through 85 confirms that the recovery has real momentum and isn't just a temporary bounce. From a technical analysis perspective, the next major resistance level above 85 is around $90 to $92. This is a critical zone because many traders who bought silver during the run-up toward 121 and held through the crash are looking for any opportunity to exit at smaller losses. There's going to be selling pressure in that 90 to 92 range from these trapped longs trying to get out. If silver can push through 92 and hold above it, that would be an extremely bullish signal, indicating that buying pressure is strong enough to absorb all that overhead supply. Beyond 92, the path is more open toward $100, which is obviously a huge psychological level. $100 represents not just a round number, but also validation that the bull market in silver is intact despite the crash. If we reach 100, it opens the door to potentially retesting the previous high of 121 and eventually breaking out to new all-time highs. But we're getting ahead of ourselves. First, we need to see if we can hold above 85 and then make a push toward 90. Let me share with you what major investment banks are saying about where silver goes from here, because their forecasts give us insight into how professional money is thinking about this market. UBS just released a forecast predicting that silver will return to $100 by next month, March 2026. That would represent a gain of about 17% from current levels at 85. Their view is that the fundamental drivers remain intact, and the crash was primarily a leverage-induced liquidation rather than a fundamental breakdown. However, UBS also notes that they expect silver to fall back to $85 by the end of 2026. Their concern is that at elevated prices, industrial demand will be destroyed as manufacturers optimize usage and find substitutes. On the more bullish end of the spectrum, analyst Alan Hibbard from Gold Silver believes silver will perform even better in 2026 than it did in 2025 when it gained 147%. He wouldn't be surprised to see silver increase by over $100 per ounce from current levels, potentially reaching $175 or higher. His view is based on the structural supply deficit, the growing role of silver in the energy transition and technological advancement, and the increasing recognition among investors that silver offers both safe haven properties and industrial demand drivers. There are also more moderate forecasts that see silver trading in a range. Some analysts project prices staying in the $70 to $90 range for most of 2026 as the market consolidates the massive gains of the past year and works through the psychological damage from the January crash. In this view, we're in a period of base building that will set the stage for the next major leg higher, but that leg might not come until later in the year or even into 2027. So what happens next? Can silver continue higher from 85 toward 90 and 100, or are we going to hit resistance here and pull back? Let me walk you through several scenarios. The bullish continuation scenario says that breaking 85 is just the beginning of the next leg higher. In this scenario, the economic data continues to come in weak, reinforcing the case for aggressive Fed rate cuts. The delayed jobs report that's expected this week shows significant weakness in employment, triggering another wave of safe haven buying. Silver pushes through $90 relatively easily because there's so much pent-up demand from buyers who have been waiting for confirmation that the bottom is in. In the bullish scenario, we reach $95 to $100 by the end of February, and the narrative completely shifts from talking about the crash to talking about the path to new all-time highs. More institutional investors allocate capital to precious metals as portfolio insurance. Central banks in countries concerned about dollar dominance increase their gold and silver reserves. Retail investors who sat on the sidelines during the crash rush back in, fearing they're going to miss the next big move. By mid-2026, we're testing the previous high of 121, and by year-end, we could be establishing new highs above 150 or even approaching 200. The moderate scenario, which I think has a fairly high probability, says that we're going to see some consolidation around the 85 to 90 level before the next major move. Breaking through 85 is significant, but there's a lot of overhead resistance from trapped longs looking to exit. We might spend a few weeks chopping around between 80 and 92 as the market digests these gains and waits for more clarity on Fed policy and economic data. Eventually, probably by March or April, we break through 92 decisively and make a run at 100. But it's not a straight line. It's choppy and volatile with plenty of 2 steps forward, 1 step back type of action. The bearish reversal scenario says that 85 represents the top of this recovery bounce, and we're going to fail here and head back down. In this view, the weak economic data is actually bearish for silver because it means industrial demand is going to collapse. The jobs report comes in better than expected, the dollar rallies, and precious metals sell off. We give back the gains from the past week, break back below $80, and eventually retest the $75 lows. If we break below 75, the next stop could be 65 to 70, as the market searches for true fundamental value in a weakening economy. Looking at all the evidence, I lean strongly toward either the moderate or bullish scenario. The bearish case just doesn't align with the data we're seeing. The physical market is too tight, with inventories at multi-year lows and rising lease rates. The structural deficit is too entrenched, with 6 consecutive years of supply shortfalls. Investment demand is too strong, with a 20% increase forecast for 2026, and the safe haven rotation is too real, with genuine concerns about dollar assets and policy uncertainty driving flows into precious metals. Breaking through $85 today is not just another price move, it's a statement that the recovery from the crash is real and sustainable. It validates the view that the crash to 75 was a leverage-induced liquidation event rather than a fundamental breakdown. It confirms that buyers are willing to step in aggressively at these levels because they understand the long-term bull case. And it sets the stage for what could be a very interesting next few weeks as we test whether we can push through 90 and make a run at 100. There are some near-term risks to be aware of. The delayed jobs report expected this week could move the market significantly. If it shows major weakness, we could see another explosive rally. If it comes in stronger than expected, we might pull back and consolidate. The Chinese Lunar New Year holiday runs from February 16th through 23rd, which could create thinner liquidity and potential volatility. And there's always the risk of profit-taking after such a strong recovery, with some traders choosing to lock in gains rather than risk riding it back down. But the bigger picture remains compelling. Silver has recovered from 75 to 85 in just 2 weeks, breaking through a major resistance level in the process. The fundamental drivers of supply deficits, industrial demand, and investment flows remain intact. The macro backdrop of Fed rate cuts and safe haven rotation supports higher prices, and the technical picture is improving, with silver holding above key support levels and now breaking through resistance. Whether we go straight to 100 from here or consolidate for a while first, the trajectory appears to be pointing higher. Breaking 85 is not the end of this story, it's just the latest chapter in what could be a historic bull market in silver that has years left to run.